My name is Matt Cohen, President and CEO of the Long Island Association. Very happy to put together this meeting of our Financial Services and Tax Policy Committee. It's a committee that we offer to our members, explores tax issues, insurance, banking issues, and the impact of various regulations in the region. It's chaired by Jeff Alter, who's the CEO of Summit Health. He's on the Zoom right now. Co-chaired by Carolyn Mazenga, the partner in charge at Markham LLP. And it's vice chaired by Miriam Tannenbaum, the market executive head of Long Island Queens Commercial Banking for Capital One, and Maureen Evers-Willocks, who's the managing partner at KPMG. They're on as well, all LIA board members. So thank you for all you do to help serve this committee. I'm very excited to have Jason Bram with us. You know, the LIA's had a long relationship with the Federal Reserve Bank of New York. We've had former presidents of theirs join us for events. Jason has been with us a few times for events to update us on the economy, both regionally and nationally. So today we're going to get the latest update from the Fed on the economy. You know, as I think everybody knows, the economy, while it's certainly resilient and doing well in certain areas, there's also certain headwinds that remain, like consistent inflationary pressures. There's still some supply chain issues. We have low unemployment, historically low unemployment, but that's also led to some hiring challenges for companies. I hear about that all the time. So, you know, we continue to hear that it's a challenging time for businesses right now. And these economic pressures have a significant impact on Long Island small businesses, which comprise the majority of all businesses on Long Island. So I want our members to know the LIA is here for you. This year, we introduced a small business support program, first time ever. It's designed to help you grow in our region. And the LIA has the back of small businesses. So with that said, this event today is going to be recorded, so everyone's aware of that, and it'll be available on demand to our members and available on our YouTube channel. So check it out then. We'll send an email out to everybody with the information for that. And without further ado, I'd like to introduce the chair, the co-chair of the LIA Financial Services and Tax Policy Committee, CEO of Summit Health, Jeff Alter. Take it away, Jeff.
Thanks, Matt. It's my honor and pleasure to introduce you all to Mr. Jason Bram. He's the research officer with the Federal Reserve Bank of New York's regional analysis function. He monitors and analyzes economic trends in the second district, which is New York, Northern New Jersey, Fairfield County, Connecticut, Puerto Rico, and the U.S. Virgin Islands. Quite a interesting semblance of markets. He participates in various advisory groups for institutions such as New York City ONB. He co-directs the New York Fed's monthly Empire State and Business Leaders surveys, designs topical questions, and writes reports on survey results. Mr. Bram has published numerous studies and blog posts on the regional and local economy, on the economic impact of disasters such as COVID and our hurricanes, the effects of minimum wage hikes, New York City's tech sector, Puerto Rico's competitiveness, commuting patterns, the role of Wall Street and new media, and has written on consumer confidence as a national economic indicator. He also gathers intelligence for and writes the periodic Beige Book that everyone hears about our district's economy. Mr. Bram joined the Federal Reserve Bank of New York in 1995 after 10 years at the Conference Board as a regional and consumer economist. Mr. Bram holds a graduate degree from New York University's Stern School of Business and a BA in economics from Columbia University. I turn it over to Mr. Bram.
Thanks, Jeff. Thanks very much. I'm glad to be here. Sorry I couldn't literally be there, but since it's a virtual meeting, I'm glad everyone had a chance to attend. I'm going to start off sharing my screen, and technology not being my strong suit, you'll have to tell me if you see it. Okay. Does it look like you can see it?
Yep, you're good, Jason.
Wonderful. Okay. Great. So I'll start out with my usual disclaimer, which means the views I express are my own and not necessarily the views of the Federal Reserve Bank of New York or the Federal Reserve System. Having said that, let's just dive right in. So I'm going to talk for maybe about 20-25 minutes and then hopefully get some good questions. Well, I'm going to start out with recent findings from our business surveys, which I'll tell you a little bit about. I'll go to an overview of local area employment trends. Employment is probably the best local and regional indicator that is both timely and fairly reliable as an indicator. Of course, there's always, especially lately, interested in housing markets. So I'm going to talk a little bit about local housing markets and wind up talking a little bit about the commercial real estate markets and remote work. Starting out with a slide on inflation, because I know inflation has been near the top of a lot of people's minds lately. As you probably know, inflation got pretty high back in 2022, especially around the middle of the year, and it's come down a bit. Now, what we do in our surveys is we ask a couple questions, not about the overall inflation rate, but about businesses' own prices. So that we're going out to a whole range of businesses, both manufacturers and service sector firms around the district, and we're asking them what's happening first to the prices they pay, and second to the prices they received. And what we do is we do a diffusion index, which sounds maybe more complicated than it is. All it is it's the percent saying that, for example, prices paid are going up, minus the percent saying prices paid are going down. So as you can see in this first chart, early in the pandemic, it got down near zero, which is sort of what we consider a neutral level, consistent with flat prices. And then over the course of the pandemic, both these measures got very elevated. And so when you're getting up to 80 or 90%, what it really means is about 80% or 90% of the businesses we talk to say their prices are going up, and basically no one is saying their prices are going down. Now, that has come down quite a bit up through December, and I wish I'd gotten it. We just literally released this morning data from our January survey, which is done in the first half of the month. And both of these are down a little bit more in January. So if you can imagine the trend that we've been seeing of these price pressures, as we call them, going from, extreme to just sort of moderately positive, have continued to recede, which is kind of encouraging. And we then asked about businesses about the prices they receive. Again, both manufacturers and service firms. So these two are kind of similar, but one, obviously the prices they receive are get closer to what we think of as consumer or finished goods and services prices. And you can see that those also got very high, not quite as high during the later stages of the pandemic. And they've since come down quite a bit through December. And once again, in January, which I wish I had on the charts, but I don't, but they're down a bit more. Now, every once in a while, or I shouldn't say every once in a while, we also ask supplementary questions, which I'll talk a little bit about. This will come up a couple times. In January, we asked, let me get rid of this. Okay, whoops, sorry. Okay, in December, we asked businesses some questions about their own selling prices, which is kind of similar to what we do in our survey. But instead of simply asking them, are they going up or down, we asked them how much they've gone up and how much they expect them to go up. Now we can I didn't want to flood you with too many charts, but you can go to our supplemental survey report that has this chart as well as others. But what we asked them in this case, which is kind of what people are interested in, is how much do you expect prices to rise or fall by over the next 12 months? And when I say rise or fall, people had the option. Very few people, if any, expected prices to fall. So we asked them about their own firm selling prices. We asked them about their own firm's input prices, and then we asked them about the overall inflation rate. And what we have is what we call a trimmed mean, which excludes, you'll get a few people that will give very, very high numbers, and you'll get a few people who say very low numbers, but we wanted to get sort of the central bulk of responses. And what you can see is that service firms are expecting a little bit less than a 5% increase in their own selling prices. Manufacturers a little more. When you ask them about their own costs, manufacturers are actually expecting a little bit less than service firms, but still around the same range of 5%. So this is obviously a mix of, different kinds of things. So you have, they have to think about energy prices, they have to think about insurance costs, they're all sort of their costs of goods sold and et cetera. So, this is a whole wide range of things. And I think the key takeaway here is that what people are expecting over the next 12 months is about 5%, which is high, but it's a lot less high than what we've seen over the past 12 months. We then asked them of what they expect for the overall inflation rate. And here they expect numbers like 5.5% to 6%. So this is kind of interesting because what they're telling us, and this is true about a number of survey measures, which I can elaborate on if you want in the Q&A. But, companies are like, when they're saying, well, how are you doing? Or what's happening with your business? They're actually more positive, or positive is not the right word. They're more upbeat about that than they are about sort of the whole economy, which tells me that, what they know best, in a sense, or what they have the best handle on, is what's happening within their business. So they're kind of saying, well, we expect inflation to be up around 6%, but our own inflation, the prices we pay and receive, are actually going up less. So I think this this gives you a little bit of an overview of what we're getting out of our business surveys with respect to inflation and price pressures. Now, turning a little bit to what we think of as the economic indicators in our survey. So, obviously we ask about prices in our survey. We also ask about employment. We ask companies, is your employment at your firm going up? Is it going down? And we ask about just general business conditions, business activity. Is it growing, or is it declining? So normally these two move pretty much in tandem. You can see that, like before the pandemic, they were both generally in mildly positive territory. And once again, this is the same kind of diffusion index, where the level of the index is sort of the net positive, the positives minus the negatives. So you have a period where, more firms say things are getting better each month than worse. More firms say that their employment is going up than going down. And then, of course, the pandemic hits and everything, kind of falls off a cliff for a while. And then you get into the expansion stages and everything goes very positive. So what we've seen in the last 6 months, and this, by the way, pertains to the service sector survey, but if we had a similar graph for the manufacturing survey, it would look pretty similar. And really the key thing here is what's happened since early 22. These two measures have sort of diverged. And we've seen this in economic indicators. So I'm not sure how closely you all follow, for example, national measures, but in the first half of last year, real GDP actually declined slightly. But employment continued to grow, which is a very unusual situation because usually the two go together. And so what we're seeing in our survey, which pertains to this region, which pertains to the service sector, is the same kind of divergence. So when you ask businesses how their business is doing, up through December, and, January continues this sort of, was also even a little more negative on the activity index. They're saying, yeah, our business has kind of gotten weaker, but their employment is still going up. And I think the reason is that a lot of places are understaffed. They'd like to hire more people even than they are able to hire. So, between turnover and a difficulty in finding qualified candidates, a lot of the employment growth that we've seen has actually been limited by what we call the supply side, about companies just not being able to find enough people. So that when business drops off a bit, they're not going to start like letting people go. Now, I know we've all heard, layoffs in the tech sector. We've heard about layoffs somewhat in the financial sector. But, if you look at the overall economy, employment has, continued to grow. Leading indicators of employment like this survey, as well as weekly jobless claims, don't show really any weakening in the employment situation. So I think the key takeaway here is that employment's continuing to grow, even as business conditions are seen as getting a little weaker overall. And then here's what we call a spider chart. It's called a spider chart because everything kind of comes together in the middle. And what it is we index things to the pandemic, the start of the pandemic in February of 2020. So the level of this measure is basically how much or below the beginning of the pandemic level it is at any given point in time. So you can see that, 10 or so years before the pandemic, employment had been growing pretty steadily. It kind of leveled off in Long Island, but was continuing to grow in New York City and the nation. And then, of course, early in the pandemic, everything again fell off a cliff and then started to rebound. And one of the things that has been a concern, I guess, or a sign of relative weakness in New York City, also to some extent in Long Island, is that even though employment has bounced back, it's lagged behind the nation. So in other words, whereas the nation, this goes up through November, but I think we actually have December numbers, but it sort of continues this trend. What you're seeing is that nationwide, employment has more than recovered all the number of jobs that were lost. But in Long Island and New York City, things have continued to lag. So, they're still growing. Like Long Island may have dipped a little, but the trend has been pretty, a sort of modest upward trend in both New York City and Long Island. Also, a lot of these charts, obviously you're interested in Long Island, but I always include New York City for the simple reason that, as you're well aware, and as may be the case for some of you, and certainly for people a large proportion of Long Island residents commute to New York City. And so the job situation in New York City obviously has effects for Long Island. Now, looking a little more closely at what's going on within individual industries, what this is just looking at percent change from what we consider the baseline, which is right before the pandemic, in terms of how are different industries doing. And we're looking at it here nationally, in New York City and in Long Island. So I'm not going to go through every one of these in detail, but I will go through a couple of them in detail. So leisure and hospitality employment fell the most everywhere during the pandemic, because the very things that shut down during disasters, and especially something like a pandemic, are things like restaurants, hotels. People aren't traveling. So leisure and hospitality took a huge hit, and then of course it came roaring back. But even nationally, it still, as of November, remained down about 5 or 6% from the pre-pandemic level. In New York City, of course, it was down much, much more, but in Long Island, it was a little higher. Well, why is this happening? Why is Long Island doing well? Why is New York City not doing well? I think one of the reasons is that, to look even within New York City, the parts of New York City that got hit really hard by this are the business districts. And it's not so much that the sort of prime businesses in those areas, like I'm here at the Federal Reserve Bank, there's like a whole bunch of financial companies around here, there's legal firms, there's all these kind of office-based businesses that drive New York City's economy. Those businesses are doing okay. What's happening, though, is that the businesses that serve office workers with, people either going all or partly virtual for, not so much, maybe less so in the past year, but certainly since, for most of the period since February of 2020, you see that it's the kind of businesses that cater to office workers that really got hit hard. Now, why is it doing better in Long Island? Well, the same people who, used to commute into New York City and they would go out to eat in the city, or they would stay in a hotel, or they would, do whatever, whatever kind of activities they did in the city. Yeah, they're still doing a little bit of that, but now they're spending, 3/4 of their time maybe in Long Island and, actually commuting 2 days a week or so. And so instead of having lunch in Midtown Manhattan, they might have lunch in Melville, or, somewhere in Long Island near where they live. And so this is where you see this big dichotomy between what I call the major business hubs and the I don't want to call it the suburbs, because I know a lot of Long Island, there are certainly business hubs in Long Island, but it's just not the same thing as Manhattan. All right, I've spent enough time on leisure and hospitality. Other services, you kind of have the similar sort of thing where, these are largely face-to-face services. They got hit hard, and these did get hit hard in both New York City and Long Island. I'm not going to go through every one of these. Construction, manufacturing, trade and transportation, all these things have been down a lot in New York City, not so much in Long Island. Information, you might see this Long Island big drop. Not to be too concerned, because it's just a very small industry. So even though things are down about 10 or 12%, it's not going to have a huge effect on Long Island's economy. Plus, in New York City, that industry is actually doing really quite well. And we actually did I think we did a blog post before the pandemic on how New York City is kind of catching up, or not catching up, but it has seen tremendous growth in what we call the tech sector, which is kind of information, certain types of business services. And so that's become a really key industry in New York City, not replacing finance, but certainly getting up near to that. Okay, so I'm going to switch gears now, look at housing for a few minutes. We use this Zillow measure. You're probably familiar with Zillow. They have a pretty comprehensive tracking of home prices as well as rents. So, they have these home price indexes that are based on, it's a fairly complicated model, but they kind of estimate the average and median prices of homes, on a month-to-month basis. So what we do here is we track, it's what they call typical home prices in Manhattan. And again, these are indexed, so they can all be on the same scale, because if they weren't on the same scale, Manhattan would be like way up there. So these are for the 5 boroughs in New York. And you can see the Manhattan, which is the gray line. Even before the pandemic, prices were pretty much flat. Then during the pandemic, when home prices sort of went up almost everywhere, they did not go up really in Manhattan. And one reason is affordability. Another reason is that Manhattan is a very dense place. And during a pandemic, people don't like so much to be in dense places. And so that had an effect on relative home prices. So you can see that even within New York City, with the sole exception of Manhattan, prices did actually go up. And especially, Staten Island is probably the least urban of the boroughs, and that saw the most price increase. So this is a very, very clear pattern here. The most urban places saw the weakest price increases during the pandemic. And I'm going to go to the next chart, which adds in Nassau, Suffolk, and Westchester. And you can see even more, pronounced this sort of dichotomy. Again, Suffolk is, the further you get out from Manhattan, the more home prices went up. So, Nassau and Westchester, and then you see Suffolk really up in the stratosphere. It's not just the Hamptons, although obviously that is a factor in this. So, now what you're seeing is some leveling off in home prices. This, I believe, goes up through November. I think December data are probably coming out any day now, but certainly I think in the months ahead, based on what we're hearing anecdotally, you're likely to see like some pullback in these home prices for the simple reason that, affordability issues, mortgage rates are up. We've been through this like huge price increase. Now let's look at rents. Same kind of thing also from Zillow. This is sort of an index of typical rents. And you again see the same pattern, both before and during the pandemic. Manhattan had the weakest growth. That's the gray line. You may notice a gap. I think the gap is actually because during that period in the pandemic, there were so few new leases signed that they didn't really have adequate data. Either that or there were just so many landlord concessions that they didn't feel comfortable with the data they had. But however you look at it, you see this huge drop off in rents in Manhattan, much less so in the other boroughs. But even rents have come zooming back to the point where they got up to 10 or 20% above the pre-pandemic levels, even in Manhattan. And since then, they've sort of dipped a little bit, but not that much. Anecdotally, though, we're hearing what we're hearing anecdotally is that actually rents have continued to drop off. But this is something that we monitor as the data come in. And then again, I'm going to throw on the outlying counties, Suffolk, Nassau, Westchester. You might notice there's been like a little bit of a seasonal pattern in Suffolk. That is likely a function of the fact that you have a lot of summer rentals where prices just go up a lot during the summer, especially, but not only in the Hamptons, Fire Island, etc. But aside from that, what you see is this big run up again in rents and also sort of flattening out or declining both in Nassau, to some extent Suffolk, and in Westchester. Now, having looked at prices and rents, you might wonder, well, have prices gone up more than rents? How do the two compare? Because one of the ways we think of home prices, like how do they relate to rents? Like, do they both go up and down together? Well, yeah, they do. But basically, rents kind of reflect current market conditions, whereas prices have a little bit more of a speculative aspect. So it, in some cases, rents can be a good leading indicator of prices, but in other cases, prices can be a good leading indicator of rents. So for example, after the 9/11 attacks and after Hurricane Sandy, a lot of rents in the hard-hit areas fell sharply, but prices didn't, because these drops in rent were seen as temporary. So you might be willing, you might not be willing to rent a place for a year in a place that's been flooded and is hard to access, but you might be just as willing to buy a place which then in the long run is going to do pretty well. So having said all that, we look at what we call price to rent ratios. And so this is the typical transaction price divided by the typical annual rent. So for example, if an apartment rents for $3,000, then it's $36,000 per year. And then actually this is 20, yeah. So you multiply that by 20 and you get something like 720,000, $1 million. And so it just lets you know how prices are doing relative to rents. And what we've seen, we picked 4 periods. So March of 2015 to February 2020, that kind of gives you an idea of what was happening before the pandemic. And you can see that in most areas, with the exception of Manhattan, price to rent ratios went up. So prices went up more than rents in most areas. During the first year of the pandemic, again, price to rent ratios tended to go up a bit. And now they've come down in at least some places, although in Nassau and Suffolk, they're still up a little. But what happens when mortgage rates go up is it changes the relationship. And I think it hasn't had a chance to kick in yet. So what you would expect to happen is, mortgage rates will tend to drive down prices, but not have that same negative effect on rents, relative to prices. So I think what we would expect to see, with the higher mortgage rates, but we haven't seen it yet, is that the price to rent ratio would go down somewhat. And again, it's gone down in Manhattan, it's gone down in parts of New York City, but it hasn't gone down nationally, it hasn't gone down on Long Island at this point. Just something I think it's useful to keep an eye on. So now, with all this positivity in the housing market, let's look at the commercial real estate market for a minute. And here you see something very different. So you see vacancy rates, especially in Manhattan, but also in Long Island, have moved up. In Manhattan, we're seeing, and this only goes up to Q3. I don't think we had Q4 in time to when we were putting together the presentation, but I think they're kind of sort of steady, but maybe up a little bit more in Manhattan and up a little bit more in Long Island. But you see in Long Island, they're not at unusual levels, whereas in Manhattan they are. And this is for the simple reason that, it's a very, very different type of market. Long Island, by the way, in this case, includes Brooklyn and Queens. So it's a mixture of, what you're going on in Nassau and Suffolk and what's going on in Brooklyn and Queens. But I think the big takeaway here is that, everywhere the commercial real estate market is doing much weaker, obviously, than the housing market. And if you think about it, the way I think about it is, you have all this stock of office space and you have all this stock of housing. And now all of a sudden, since the pandemic, some of the work that used to be done in quote offices is now being done in home offices. So people need bigger homes, people need more housing, or they want more housing. And office, companies in office buildings need somewhat less space. So it's created this sort of dichotomy between commercial and residential real estate that is something that's been actually going on for a long time in New York, in Manhattan. And if you looked at the number, I don't have a chart on this, but if you looked at the number of office, kind of older office building to residential conversions over the last 10, 20, even 30 years in Manhattan, it's been pretty substantial. I don't think we've seen the same thing in other areas, but it's something that, you might start to see. I think one of the reasons is that a lot of the older office buildings in Manhattan are kind of conducive. I mean, you look at these office buildings and you're like, yeah, those would make nice apartments. But if you look at kind of a small office building in a strip mall somewhere outside of the city, there are just some office type structures that are not really convertible that easily. And actually, some of the office space in Manhattan is hard to convert to, for the simple reason that a lot of it is interior, it doesn't have windows, et cetera, et cetera. Having said that, though, what's happening is, as rents and prices have gone up, office rents and at least office rents and of course the vacant supply of office space have weakened dramatically. And this brings us to my final couple slides. We did surveys back in the summer in August, and we asked companies, we wanted to get a sense at that point, how, before the pandemic, during the pandemic, or in the middle of the pandemic, and then currently, and what people expect. How many of your workers are working remotely at least some of the time? And of those workers who are working remotely, how much of the week are they working remotely? So in other words, are they coming in 2 days a week? Are they coming in 4 days a week? Are they not coming in at all? And so we had responses that range from 0% to 90%, and then some firms just said they didn't have people working remotely. Now, this includes all service firms, so it's not just what we might think of as office workers. This includes restaurants, and where obviously you're not going to have the same kind of remote work. It's going to include hotels, right? The hotel maids aren't going to work remotely, but the general thrust of this is that before the pandemic, you had a moderate, percentage of work hours being done remotely. And when I say work hours, what I mean is, this is the number of sort of person days that people are working remotely as a percentage of all work that's done. In June, in the middle of the pandemic, of course, got really high. It's come down, but it's expected to come down. This was done in August 2022. It was expected to come down a bit in 2023, but not all that much. And so I think the takeaway here is that remote work, we're coming back from the pandemic, but it's here to stay. Like the fact that more than twice as many business, or I guess twice as many hours are being worked remotely, or expected to be worked remotely a year from now versus before the pandemic, really tells you a lot. And I think what it's done is it's accelerated a trend that ever since I've been in the workforce, the percentage of remote work, people telecommuting or doing, what do they call flex work schedules, has grown gradually over time. And this kind of basically, probably the pandemic has compressed what might have been the next 15 or 20 years of this gradual increase in remote work into a 1-year period. And then finally, almost finally, in our surveys again in August, we say, compared to before the pandemic, what have you done with your business's footprint? So for example, for an office, it would be they're using more or less office space. For a restaurant, it might be, if you expanded your the number of tables you have. So, some companies have actually, especially in the service sector, expanded from before the pandemic, but obviously more reduced than expanded. And so these are the bars on the left. So what's interesting though is, you're talking about even among service firms, 16% reduced, but 84% did not reduce their footprint. Now, when you get into manufacturers, even more the case. So, now 16% may not look like a lot compared to 84%, but it can add up to a lot of office space. What's more interesting, I think, is we say, okay, how about in the next 1 to 2 years? And we actually had more firms saying they were going to expand their footprint than contract it. Now, keep in mind that this doesn't mean there's going to be more demand for office space. What it could mean is that smaller firms are increasing their footprint and bigger firms, if you have one Amazon and they're reducing their footprint by 20%, that will offset, 50 small businesses increasing their footprint. So you have to take these numbers with a grain of salt. But nevertheless, it suggests that, the future decline in demand for office space may not be all that, dramatic as is expected. What is happening, though, I feel like I'm rambling here a little bit, but what is happening, though, is that office and commercial leases tend to be fairly long. And so there are a lot of companies that, as they're rolling off the lease, they reduce the amount of space. So this kind of drags the whole process out, possibly for quite a few years. So you might have companies that, like in 2020, are like, God, we wish we could, cut our footprint in half, but their lease comes up next year. So they might, next year reduce it by half or a third or whatever. So we'll have to wait and see. Anyway, all this is to kind of get to the whole idea of less office work, more remote work, really having an impact on the commercial real estate market. And here, I think, is my last slide. We monitor this as I love this indicator because it's daily, and it looks at New York ridership on New York subways and the Long Island Railroad. Also has buses and such, but I thought these would be the most interest. And you can see compared to the comparable pre-pandemic day, so think of day of the week, think of time of the year, etc. It dropped off by almost 100%, initially as the pandemic really hit New York City hard. And it's come back, but you still, even to this, I won't say to this day, but to early January, Long Island Railroad ridership and New York subway ridership still down about 35%. from where it was pre-pandemic. A lot of that is on weekdays as opposed to weekends, and an awful lot of it is happens to be on Mondays and Fridays. Sorry to get so much in the weeds, but what's happening is the work week, which generations ago was 6 days, then went to 5 days, then kind of went sort of to 4.5 days with Fridays in the summer, and now it's kind of gone down to 3 days on average, though obviously a lot of businesses are open 5 days, 7 days a week. But this has affected ridership because a lot of the subways and the Long Island Railroad depend on commuters for their ridership, and it's down by over a third even now. And that pretty much finishes it off. One more thing I want to add. If you look at, well, I don't have the chart on it here, but I've looked at it. Just as many people are driving in. So I think what you're seeing a little bit is yes, there are fewer people commuting, but a somewhat higher proportion of commuters are driving to their workplace versus using mass transit. That may change at some point if we have congestion pricing and such, but that's how it stands now. So just to wrap up, I probably don't need to read these, but our business inflation's receding, employment is still below pre-pandemic levels, and job growth slowed, but employment continues to grow even as the economy has been a little weak. Local housing markets have cooled in recent months, but they're still very elevated, and I think housing demand going forward, for the reasons I mentioned, will likely stay pretty strong. And then commercial real estate markets have been weak. So that went a little longer, but yeah, I'm done, and we'll love to take some questions.
And that, ladies and gentlemen, is why we keep asking Jason Bram to come back. That was a really, really terrific and informative presentation. Thank you. It was great. Thanks, Jason.
Great.
And it was not too long. It wasn't too long. I see. So now we're going to turn to Q&A. You can either raise your hand or put it in the chat, and I'll call on you. I see the first question. Maybe, Jason, you could stop sharing your screen.
Okay. Did I stop? Did that work?
I still see it.
How about now?
There you go. First question I see, hands up from James Medor.
Hi, James.
Hello, good to see you, sir. Thank you for doing this, and please continue to do those supplemental surveys. We love supplementary questions, as you know. Let me ask you a question about economic growth and the potential for a recession. As you know, the Bureau of Labor Statistics very recently released GDP figures for the counties. Long Island's economy is $180 billion. It grew very substantially between 2020 and 2022. 2020 and 2021, but we don't have the data, right, for 2022. And a lot of the small business people I talk to, they are very fearful that we are going to fall into a recession in 2023. What's your outlook for GDP growth and for whether or not we avoid a recession?
Okay, I'm trying to think of a way to answer it that I can do. Because we don't make predictions, and even if I had my own thoughts, it's tricky. Let me answer it as best I can. So yeah, there's a lot of concern about recessions. When you ask businesses how they're doing, I think there's this sort of again, this is anecdotal, and this is we do this Beige Book report on the regional economy every few weeks or so. And what we've been seeing is, yeah, businesses have said that things have weakened a little, but, they don't, I think there's still, most businesses are not expecting their own business to drop off in the months ahead. So there's this sort of fear like, oh, everyone else is, the economy is going to hit a recession, but like we're doing okay. Even though December, as you saw, and January, which just came out, I think today and yesterday, our surveys were weak. They looked pretty, negative in December. But even then, expectations, stayed kind of positive. So, I'm not going to get into, predicting, whether, when, what there's going to be a recession. but I can tell you what businesses are saying, and they seem to think that the outlook for their business is, not stellar, but not bad. I mean, and so there is that concern, but you know, the fact that employment is continuing to grow, to me, and that's probably the best, most reliable regional indicator, is encouraging. And the fact that even like what I consider the one of the better leading indicators of employment, which is weekly jobless claims. You're gonna get new numbers tomorrow. Maybe they'll be, I don't know what they'll look like, but they've been pretty stable at very low levels. So you hear a lot of news, you hear about a lot about layoffs in the news. But keep this in mind, if I don't want to pick out individual companies, but if some large company announces they're laying off 20,000 people, just keep in mind that every week, the number of new jobless claims is in the 200 to 300,000 range. And that it's not that 300,000 jobs are being lost each week, is that you get all this churning. So new jobs are added, some jobs, are seasonal, some jobs just end, people jump from one company to another. And so even though you have this kind of, jobless claims, and by the way, jobless claims running in the 200 to 300,000 range is still pretty low. You hear about layoff announcements, but you don't hear when some small companies hiring like 8 people here and 10 people there, and that's kind of why we do the surveys. And so having said that, the surveys are looking negative right now, but we'll have to wait and see, because December and January tend to be kind of down months. People, even like companies that are doing well, aren't usually hiring, aside from retailers, but certainly in January. And we'll have to wait and see, the next couple of months. So I know I didn't really answer your question, but I did the best I could.
Thank you, sir. Good to see you.
Same.
Does anyone else have a question? Either raise your hand or put it in the chat.
It looks like there's one in the chat,
Oh,
Matt.
there you go, from Control Central Inc., WBE, Pat Harper. What about new business development?
Yeah, so I haven't looked, but I mean, new net business formation is actually a really good indicator of the economy. I think it depends on different areas. So right now, manufacturing has been kind of weak, but manufacturing had a very, very strong run, for much of the pandemic. And even though restaurants and such are still struggling, things like tourism, like one thing that's really done well in New York City, and that probably has some effect on Long Island, is tourism. So we have tourism, all the people that postponed trips during the pandemic are visiting New York City, like hotel occupancy rates and other measures in New York City, and to some extent, I think in Long Island too, are at pretty elevated levels. Room rates are kind of near record levels. Attendance at a lot of these sort of tourist destinations is actually doing quite well. So there are strong segments of the economy, and we're at a point. 2022 was a rough year. I'm not. Obviously, the Fed raised rates a lot to try to stave off inflation, which creates, it's tricky while rates are going up. Suddenly, it's harder to sell a home. Loans become more expensive, etc. But given that we've gotten through 2022, you had the Ukraine war, you had gas prices shooting up. And a lot of the price measures seem to be sort of stabilizing. So I guess the bottom line would be that I would expect new business development to be pretty good next year. Again, my opinion, not the Federal Reserve's, but I'm pretty optimistic about that.
Great. Does anybody else have a question? Going once? Going
Oh, there's another question in the chat.
twice.
On the price
You know
of-
what, Matt,
It was
I
Maureen
don't know if there
Compliment.
is, but
Go
I
ahead.
have one. Jason,
Sure.
you know, we read a lot about the influx of, you know, the immigrants seeking asylum. So, you know, I think obviously in the short run, that's a negative because of the impact on, you know, New York City's economy and taxes. But, you know, we hear so much of jobs that are going unfilled. Do you see somewhere in the future that there's a silver lining to this, that at the new immigrants could be a new economic engine in 2 or 3 years for the New York City economy?
Oh yeah, I mean, keep in mind, you know, I've lived in New York City for much of my life, and you know, during the 1970s and 80s, well, more in the 1970s, but certainly, you know, ever since, you know, always, there's been the influx of immigrants has kept New York City resilient. As you know, if the immigrants had not been coming in when New York City was undergoing its, you know, very deep recession and fiscal problems and a big out-migration, you know, a lot of cities really like lost a third of their population. And in New York City, population went down a little bit, but, you know, the influx of immigrants offset a lot of the outflux, if that's a word, of, you know, local residents. So, you know, from the point of view of housing, from the point of view of like filling jobs, from the point of view of just having a, you know, robust economy, yeah, I do think that, you know, immigration, there's been a lot of research that, you know, immigration on net is a positive for the economy. I'm not saying that like every economist agrees on that. There's nothing that every economist agrees on, but most economists would agree on that.
Next question I see in the chat from Ron Loveland, Summit Safety and Efficiency Solutions. What risks in the economy are you watching that may influence how the economy will do? Parentheses, more COVID, war in Ukraine, another shock, etc.
Those, yeah. I mean, you know, one of the things that I didn't really mention that I think has been a concern is, you know, it's nice that the newer strains of COVID are not nearly as deadly as the earlier strains, but, you know, COVID is still, you know, there's still a lot going around. It's causing, you know, some absenteeism. It's, you know, it's obviously having at least some negative effect on productivity. And, you know, there's still a lot of research, I guess, in progress, but suggesting that that long COVID is a problem. I mean, you've had a large share of New York City residents, you know, I mean, have had COVID, and probably the percentage, and when I say New York City, I'm the region, Long Island, I'm talking to, you have to imagine that, you know, some people are affected by long COVID. And, you know, there are a lot of things that are holding labor force participation down. I know for a while, for example, the what do they call those addictive drugs? I forgot the word, but
Opioids.
oh, it's
Opioids.
opioids. Thank you. Opioids. I need some more coffee myself. Opioids. The opioid crisis was probably holding it down. You now have, you know, the opioid crisis is probably not as bad as it was, but you do have COVID. You know, you have many factors. You have people needing, you know, to do childcare because they can't find a nanny. They can't find someone to watch their kids. You have issues that, for example. So I guess, you know, when you talk about risks, yeah, I think, you know, the war in Ukraine, shocks, you know, we don't know what's going to come out of left field, but, you know, I think the economy has been able to sustain the rise in mortgage rates and such. So that part to me is not the risk. The risk is, stuff like that we don't know. Stuff like long COVID, stuff like maybe a new strain, God forbid, later this year might emerge that's, more deadly. I mean, there's a lot of risks out there. There's also a lot of upside potential. One of the things, we do a lot of outreach and we talk to people, businesses, community groups, and probably I would have to say in the last couple of years, yeah, we hear people saying, yeah, it's hard to find workers, but the biggest complaint we hear is about housing affordability. And the housing affordability ties into worker shortages, because what a lot of people are saying is like, we can't get people to come here because they can't afford to live here. When I say here, I don't mean, here, Long Island, I mean everywhere. And we've heard this even in upstate New York. And so the housing affordability, has always been a little bit of an issue in New York City, but now we're hearing it everywhere, even in like Puerto Rico, which is part of our district too. I haven't really talked about it. Housing affordability is a top concern that we hear about. And, I'm going to turn that around as a positive thing. Home construction, the green, there may not be huge demand for office space. There's a lot of office spaces like come on the market in New York City over the last few years. But housing, I mean, to me, that's certainly a potential positive in the economy, being able to address housing affordability and, growing the economy at the same time.
Okay, before I see another question in the chat, but it's from someone that's already asked a question. Before we end with that question, is there anyone else that hasn't asked the question yet that would like to? Anyone else? Okay, so then in that case, we'll end with the question again from Pat Harper, I believe it was. How are wage increases affecting the economy, economic recovery on the backside of the pandemic?
Well, I think, this is true on a larger scale. I'm not just talking about Long Island, but, over the last few decades, one of the noteworthy trends has been that labor income as a percentage of total GDP has been drifting down. Right. So, I won't say wage increases haven't kept up with inflation, because they have, but, have they kept up with productivity growth? I guess the question is like, what should wages be? And, I think wages are now sort of catching up, you could argue, to levels that are more consistent with, historical trends. So, I mean, I think to me it's a positive effect, and but they're not going up. Certainly over the last year they've gone up, but they haven't gone up to the point where you're in this like sort of wage inflation spiral, like we had, I don't know, in the 70s. Wages have been rising less rapidly than inflation over the past year, but they have been rising more than they had like prior to the pandemic. And so, yeah, I don't know if that answers the question.
So we've run out of time. I want to thank you, Jason. Again, just a phenomenal presentation as always. Really appreciate you taking the time out of your busy day. See James Medore clapping. Oh, you got one more.
Well, there was another question that's related to that, so I'll just throw in a phrase here. So we've done a lot of work on minimum wage. One of the things about the minimum wage is, obviously there's the concern that, if you make restrictions on, oh, you can't pay people less than this, that you're going to eliminate some jobs. Well, we did some research on the New York-Pennsylvania border to see, basically you have these counties on the New York side that have had a much, much higher wage than people just across the border in Pennsylvania. And, we hadn't really seen any weakness in employment. What you have seen is higher wages on the New York side of the border. Now, if minimum wage close to $15 in upstate New York hasn't led to job loss, it's hard to imagine that, you know, anything going on in New York City and Long Island is going to be that restrictive that it's going to really have really much of a negative effect on employment. So that's my sort of roundabout answer on that.
Thanks again, Jason. I want to thank Jeff Alter and who chairs the committee, Carolyn Mazenga from CEO of Summit Health again, co-chair Carolyn Mazenga from Markham, and the co-vice chairs Maureen Evers-Willox from KPMG and Miriam Tannenbaum from Capital One. Jason, again, you were great. Thanks for the time. We'll ask you back again soon. And if anyone has any other questions they didn't get to, we'll try to connect you with Jason. So with that said, hope everyone has a great rest of the day and great rest of the week, and we'll see you soon. Take care.
Great. Thanks a lot. It was a pleasure.
Bye.
Bye-bye.